All right, let's get back to our guest, Conrad DeQuadros, partner and senior economist over at RDQ Economics. You know, Conrad, you were saying before the break that in terms of the economic backdrop, things are settling down in your view, right?
I think so. I mean, we've certainly moved away from the extraordinary weak conditions that we had earlier this year. We had a 3.5% growth rate for the third quarter. They'll probably get revised down, but I think we're on a path of around 3% growth over the next several quarters.
What about things like housing? And, you know, I was watching an interview Meredith Whitney did, and she talks about another leg down in the residential real estate market. She's worried about that. She talks about the pullback that we've seen in consumer credit. It's about $1.5 trillion in terms of consumer credit. These are dramatic numbers. This is not good for the consumer.
Well, I think there are a lot of well-advertised risks and headwinds to the economy, and obviously non-residential real estate is one of those. The consumer is still a big uncertainty, although the consumer is performing better than I think a lot of us thought earlier this year. But we do have some other positives. We have the fact that the manufacturing sector is performing quite well on the back of a slowing inventory liquidation. That's only just started.
Quite well. It's relative, though, to where we were, what, a year ago and so on, or a few months ago.
Well, even if you look at more recent, if you look over the last 3 months, for example, industrial production this morning was a bit of a disappointment,
right.
but it's up 8.5% over the last 3 months at an annual rate. And that's a pretty solid growth rate, and we're not comparing to last year when things were extremely weak. So, you know, I think there are positives. I think the manufacturing sector is a positive. I think that capital spending is starting to pick up. The capital goods orders data in the third quarter were very strong.
Well, why does the Fed continue to put out words of caution? Think about what Ben Bernanke said just yesterday. I mean, he's still obviously worried about things.
Well, you know, I think there is a good reason to be worried, and I think the Fed has to be, even if they're optimistic. I read his comments as being optimistic, but he was very cautious and talked about the risks. At the same time, I think the Fed wants to make sure that they don't get people thinking that their view is the economy is strong enough for them to start to take some of these accommodative measures away. So, you know, I think the Fed is saying that the economy is growing, but they still believe that they need to keep their policies in place, and you know, I think that's somewhat debatable.
Let me ask you about your really somewhat optimistic view on jobs. You think that we're going to be back down under the 10% level at the end of next year. John Malden over at Millennium Wave thinks that we could be above 10% for the next 3 to 4 years. I mean, why do you think we could move back down? What's going to help spur job creation?
Well, you know, it's obviously still a very elevated unemployment rate that we're forecasting for the end of next year. I think that the most recent reading was probably something of an aberration related to the small sample size. The household survey is so small, there's a lot of volatility in it. So I think in the near term, we might see a bit of a decline and average around 10% over the next couple of quarters. Going forward, though, I think a 3% growth rate will sort of stabilize the unemployment rate and maybe give us a small decline. I'm not saying I expect to see significant improvement in labor market conditions, but I do think that the peak in the unemployment rate is going to be somewhere close to 10%.
Do we hold there, though, once the government starts pulling away this stimulus, once the quantitative easing starts to be reduced? I mean,
you know, I'm not so worried about the government pulling away the stimulus. In fact, on the fiscal side, more of that stimulus spending is going to take place next year than it did this year.
But it won't add to growth, according to Christina Romer.
Well, you know, possibly. I think there are other positives. I'm not saying that the fiscal situation is what's going to be boosting the economy, but I do think that we're on a path of around 3% growth. I think that the problems are, or the concerns are, for what happens after that. I mean, 2011 and beyond, I think, is something that's quite concerning to us.
Is that what you say? It's debatable that the Fed kind of needs to keep the current policies in place? I mean, are you worried about an asset bubble at this point?
Not yet, but I am worried that the Fed's policy stance is overly accommodative right now. We still have an emergency stance of policy. The Fed really hasn't made that many changes, despite what they like to say. Some of those programs have wound down on their own, but the balance sheet is still over $2 trillion, which is an emergency stance of policy, and the emergency seems to have passed. So I'm not saying advocating tight monetary policy, but I do think that the Fed needs to take away some of these emergency measures.
Let me ask you quickly before Alan Blinder comes on. What is your take on, you know, we were talking earlier about the tax credit as one possibility to create jobs. What about just creating them automatically from the federal government through the state level, as he's also proposed in his op-ed piece in the Wall Street Journal?
Well, a lot of the programs to date have sort of prevented larger declines than would have taken place rather than actually created jobs. I think if there were some well thought out infrastructure programs that created jobs, I don't think that would be a problem at all. I don't believe that can be the only source of growth, though. I think that a lot of the growth in the labor market has to come from the private sector.
All right. Hey, Conrad, thanks so much for joining us. Conrad DeQuadros from RDQ Economics.